All right, listen up. I'm Daphne, and this is your silver update, Commodities Bitch style. What I'm about to lay out is going to blow up whatever you think you know about the silver market right now. The financial media is out there spoon feeding you garbage headlines and kindergarten explanations. They're pointing at the smoke while the house is already on fire. They talk symptoms, they never talk causes. We're not doing that here. We're watching history being written right now, Thursday, January 29th, 2026. As we speak, silver is trading at 117.29 per ounce. Gold is at $5,247.30. Earlier today, silver tagged 121.76. Gold hit $5,596.20, and then both got absolutely smacked. I know how this feels. Confusion, panic, red screens everywhere, portfolios bleeding out, everyone screaming the same question, what the hell just happened? Here's the truth. What you're staring at isn't the real fight. The price action you're glued to, that's the bait. The real war, the one that decides the next 30 days, is happening somewhere most retail traders never bother to look. While silver was ripping higher, a hidden force was already loading the gun, and when it fired hard. Earlier today, $6 trillion was erased from global markets. Liquidations piled on top of liquidations. Margin calls triggered more margin calls. Over-leveraged traders were vaporized in minutes, and almost nobody understands why, because almost nobody is watching the right damn chart. The variable that matters comes down to three letters: DXY, the US dollar index. This had nothing to do with inflation narratives, nothing to do with industrial demand, nothing to do with China export controls or solar panels. That stuff is noise. The real driver, the lever that decides whether silver rockets to $150 or snaps back to $80 in the next 2 weeks, is US dollar strength, and today the dollar showed its teeth. The seesaw flipped, and if you don't understand how this works, you're reacting instead of positioning. So let's rip the cover off the machine. Gold and silver are priced in US dollars, period. That's the base layer. When the dollar strengthens against major currencies, the euro, the yen, the pound, the Swiss franc, it takes fewer dollars to buy the same ounce of silver. Price drops. When the dollar weakens, it takes more dollars and price explodes higher. This is not coincidence. This is not correlation. This is mechanical cause and effect. Picture a playground seesaw, dollar on one side, metals on the other. Dollar goes up, metals go down. Dollar goes down, metals rip higher. They cannot rise together. Physics won't allow it. That's why professionals don't obsess over silver candles alone. They stalk the DXY every hour because it tells you what silver will do before silver does it. The dollar index tracks US dollar strength against 6 major currencies: Euro, 57.6%, Japanese yen, 13.6%, British pound, 11.9%, Canadian dollar, 9.1%, Swedish krona, 4.2%, Swiss franc, 3.6%. When those currencies weaken, the DXY rips higher. When they strengthen, the DXY drops. And because gold and silver are priced globally in dollars, their prices move inversely, with brutal precision. Today, the DXY spiked violently. Retail traders staring only at silver saw strength, chased momentum, piled in with leverage at $121. And then the floor fell out. Stops detonated. Positions were liquidated. Capital got transferred to traders who were watching the dollar and knew exactly what was coming. Institutions run algorithms that track the DXY in real time. When it crosses certain levels, automated sell programs unload metals instantly. These machines move faster than humans can blink. By the time retail sees red candles, millions of ounces are already gone. That's the game. And here's the good news. Once you understand it, you're not the prey anymore. Now let's talk about why the dollar surged today, because cause equals foresight. There are 3 forces driving dollar strength right now, and all 3 are accelerating. Force 1, the Federal Reserve. The Fed is staying hawkish. Rates are high. Inflation control beats growth. Higher rates pull in foreign capital. Treasury yields climb. Dollar assets look juicier. Global money converts into dollars, and metals get crushed. Force 2, global fear. When markets panic, money runs for safety, and the dollar is still king. Geopolitical risk is everywhere. Middle East tensions are escalating. Iran is threatening retaliation. The EU labeled Iran's Revolutionary Guard a terrorist organization. The US is ramping up military presence. Iran announced live fire drills in the Strait of Hormuz. Trade war threats are multiplying. Government shutdown risk is real. Fear feeds the dollar, and the dollar punishes silver. Force 3. China weakness. China is the biggest industrial silver consumer on the planet. Mixed data, slowing growth, delayed stimulus, weak industrial output, all of it pressures silver. Capital leaves China and floods into the US, strengthening the dollar even more. These forces stack. Dollar up, metals down. That's the weapon that nuked 6 trillion in 60 minutes. But here's what most people completely miss. Today was not random. This exact setup has played out twice in the last 60 days. December 25th, 2025, market crashes, silver collapses, gold dumps, panic everywhere. Then January detonates. Gold rips 30%, silver launches 65%, its biggest monthly gain in decades. December 31st, 2025, same movie. Violent sell-off, then a monster recovery. By January 26th, 2026, silver hits $109 and gold clears $5,300. Every crash lined up with a DXY spike. Every recovery followed a dollar reversal. Today fits the script perfectly. Silver dropped from $121 to $18. Gold slid from $5,600 to $1,100. If history keeps rhyming, and so far it is, stabilization could show up by February 1st, with a potential run toward $150 by mid-February. The pivot point is the dollar. Now pay attention to February 1st, 2026, the U.S. government shutdown deadline. If Congress doesn't pass funding by midnight on January 31st, the government shuts down. First reaction? Fear. Fear boosts the dollar. Metals take a hit. But the second wave is where it gets wild. A shutdown screams dysfunction. Confidence cracks. The story flips. Capital starts questioning the dollar's foundation. And when that happens, the DXY rolls over and metals explode. We've seen this playbook before. 2013, dollar up for 36 hours, then a violent reversal. 2018, shutdown fears sparked a spike, followed by sustained dollar weakness. If the shutdown is avoided, the dollar softens, volatility drops, and metals grind higher. If it happens, the first 48 hours will hurt, but the 72-hour window after that could be the buy of the decade. Either way, both roads point higher by mid-February. Now let's talk leverage, because this is where accounts died today. Leverage is a chainsaw. A 12.3% drop in silver at 5x leverage equals a 61.5% loss. Accounts liquidated, positions force closed, capital gone, unleveraged holders lived. If you're leveraged right now, cut it. Volatility is savage. And if you bought it 121.76 or 5,596, yeah, it hurts. But timing errors happen in every bull market. 2020, gold fell 30%, then hit new highs. 2008, silver dropped 50%, then later touched $50. The long-term case for silver is stronger than ever. Industrial demand is rising. Supply is tight. Geopolitics are pushing de-dollarization. What changed wasn't the thesis. It was the dollar. And dollar strength never lasts. Here's what I'm watching over the next 72 hours. The DXY. The February 1st shutdown deadline Fed speakers. China economic data. These matter more than any headline. So here's the call. Clean and clear. If the shutdown is avoided, silver rips to $140 by February 15th. If the shutdown happens, silver may dip to $90, then run to 155s by month end. Different paths, same destination. Today wasn't the end. It was the shakeout. The dollar is the weapon. The DXY is the trigger. February is the battlefield. Stay sharp, stay loud, and above all, stay positioned. Over and out from your commodities bitch.